Welcome to episode 5 of Finance and Foundations from the Bridgemore Capital team with myself, Chris Brito, and myself, Joe Eden. So this week we're going to hand the reins over to Joe with the subject matter.
The subject matter today is focused around how and when can you get a investment valuation on HMO properties, which is a common question we get asked all the time.
It's a big question. It's a big question and a lot of different factors. So obviously the easiest place to start is that if it's in an Article 4 area in the UK, which is normally put in place because of saturation of HMOs, there's the likelihood you're going to get a commercial valuation as long as you've got the appropriate plans in place. The second tier down is when you've applied for sui gem planning, which is always going to be needed for a 7-bed plus HMO property. In those situations, again, you're always going to get a commercial valuation. I say always, 90% chance of getting a commercial valuation. It's then when we kind of get to the 6-bed less circumstances where they find it can sometimes be a little bit great. I think the biggest way to get yourself a commercial valuation for a 6-bed in a non-Article 4 area is to make sure that you've done enough to the property to make it not livable for a normal residential family. Something that the best way that I always say to my clients is to make it 6-bed all ensuite HMO. Mm-hmm. So every room having its own ensuite shower room and toilet. Some people, although now, have started to go from en-suites to more studio type rooms with kitchenettes to increase the monthly rent. Mm-hmm. But certainly if you're spending a decent amount of money, I think on 6 beds now, you're looking at anything 150 to 200,000 pounds.
Predominantly in the kind of Essex borough.
Yeah, mainly in Essex borough and up north, maybe you can get build quotes and costs maybe a little bit cheaper.
What would you say to someone if they were trying to get a commercial val on a 5-bed?
I would say very similar to kind of what I just put across for the 6 is that as long as it's an all ensuite HMO, you've spent, a decent sum of money, 120 grand at least on the property, you can see that it's not going to be easy for a residential family to go in and quite quickly change it back to being suitable for them. Mm-hmm. Then again, I know there are bridging and development finance lenders that will honour an investment valuation and instruct an investment valuation. And I also know there are exit lenders that will also instruct an investment valuation.
So it's just whether the valuer deems there's been enough work.
Enough material change.
Enough material change on the property.
Exactly that. The other thing I think that's some people, like I've had, this is going to be a bit of a not controversial, but I've had various different clients that have done 6-bed HMOs. And I've had clients that have bought in a said area and another new investor has heard about that investment valuation and what that end value's been. Theirs has come back, say 40 grand lighter. And I think this is something that's probably good to touch on for the audience is that why can some valuations for 6 beds be different to others in the same area, even if it's the same first 3 letters of the postcode? And there are a few different things. So when a valuer goes out, they're going to be looking at the yield, which is based on the rent versus the sale value, and they'll be looking for comparables in that area. Now, what they'll do is they'll go, right, okay, so the comparables might be, 10 to 14%. And then they might have 3 at the higher end and 2 at the lower end, which means they're going to lean towards the yield of this new one, going towards the weighted difference. Mm-hmm. And then obviously you've got the room rents to get you your average across the year. Now with the room rents, what's important to know is the valuer's not going to look at what you're letting your HMO out for.
Or what's on spare room and it's been
or on spareroom.com. They're going to be looking at actually rents which are being achieved here and now and utilizing that information to put together and then use that for your market value rent. They don't care what yours is at the moment. They need to know that if for some reason everyone left your property, what the market value rent is going to be.
Relet them and fill the block.
Relet them and fill the block straight away.
So you're saying to get your rent accurate, you should be looking at spare room of what's been let or on Rightmove? A lot of people are now putting Raspberry Reds on Rightmove. So letter grades and using them figures, not
to certainly quantify what your end value might be. I think it's different if you want to quantify what the potential is of the asset, because you might know other people that have just got room rents in the area, or you might be speaking to an agent that's just achieved room rents in the area. So you might be thinking, actually, with mine, I know that I might be able to get £1,100 a room per month.
Yeah.
But the reality is, a valuer is only going to look at what is being achieved in the here and now in the last, 6 months.
Yeah.
And within a quarter-mile radius.
The best way to probably describe that is kind of when the market's rising in sales, you've got historical trends that may be, 5% lower than what they are now, but valuers are using historical data. Is that right? So we're saying stack your deal on if you're acquiring something, stack the numbers on a mid-tier basis, not worst case scenario, mid-tier basis, but expect that on the back end, your rental profit's going to increase, maybe not your end value, your rental profit based on what people are actually achieving in the area.
Yeah, and look, there's different ways to do that. You can speak to other investors in the area. I think we've touched on this before in a previous reel or podcast. But speak to other investors in the area, see what they achieved, how long ago that was in terms of what their valuation was, which would have been based on comparables. See if you can get a copy of it to try and steal their comparables.
Yeah.
Ask local agents to find out what any of the sales have happened and that they've got proof of, again, in the area. And the same with rents. And use someone like us as well. Like we obviously know a few different valuation companies. We know a few different lenders that might be happy to share what certain like room rents and yields have been in said areas for recent valuations. If we've got that kind of data, that's just allowing us to help the client and protect the client from an unrealistic valuation target and then huge disappointment on the back end when they refinance and they're hoping to pull out X amount of money or leave only a little bit of money left in the deal. But I guess the other thing that's important to know, going back to kind of like the comparables of what someone having a lower valuation in the same area of someone else, is that I've spoken to different valuers on this point. Well, how comes on that one that you've done it 50 grand higher? So there's different reasons. So on the yield side, it's going to be down to comparables. And then in line with those comparables, they'll then compare size of communal spaces, size of the overall plot of the property, the quality of the property. So a Victorian house is going to get a better yield than a council house, because the way the valuer looks at it is if an investor comes in and wants to buy said asset, if they see a Victorian nice, beautiful house versus a council one, they know that even if they change that back away from a HMO, it's going to be far more lucrative and appealing to a family that might want to buy and move in, if that makes sense.
Do you feel that's been a change over the last few years with valuers? Because we know people that have bought in areas that aren't hugely attractive from like a residential perspective, but they've got pretty decent yields in certain areas in Essex. Do you think the valuers are changing their stance on that a little bit as saturation increases?
Maybe. Maybe valuers are scared of like, I mean, obviously reselling a HMO at its highest possible value is a tough thing, right? That's why people buy them to hold.
Yeah.
But certainly a valuer differentiating between a quality house to a non-quality house, I think is actually important, because take away the rents and you do them on bricks and mortar, a nice Victorian style house is going to be worth a hell of a lot more than a council house. So how can you value two houses that are getting the same rent, both 6-bed HMOs? How can you value the same? You can't. If one's a bigger plot and one's a Victorian style house and one's a smaller and a council house, it's going to get a lesser yield on it.
Yeah,
because of those reasons. Then you've got the other things, is the location within the location. So if in said postcode, the HMO is right next to the hospital versus one that's another 20 minutes from the hospital, that one's likely to get a better room rents. Then you've got room sizes. Again, bigger room sizes are going to get bigger room rents.
I think developers are starting to take more notice of that, aren't they?
Yeah.
Rather than just trying to meet minimum standards, trying to get almost have the better quality product, rather than just trying to compete and get the most amount of rooms for the highest.
Yeah, 100%. 100%. And then you've got going back to your point, of people realizing about quality. So the better quality HMOs are obviously going to get a better room rent, and also a better yield, because the person has created something a lot more appealing to the next investor if they were to sell it.
Yeah.
So if you do it cheap, it's not going to be as attractive to the next buyer. Then now, you might have some people that go, well, my property is just as good as Jeff's property. I don't know why I use Jeff, but
Good old Jeff.
good name, Jeff. Same quality, same size, next door to mine. Why is my valuation different to his one from 9 months ago? Why is it less? Saturation.
And value of choice?
It could be value of choice, but I've had a situation recently, it was the same valuer.
Right.
And it comes down to saturation. And if everyone's trying to do the same great thing, great finish, same room, large room sizes, all studios, all singing, all dancing, good location, good communal areas, but time has taken its toll in terms of the volume of good quality HMOs. It's like anything. If you put loads of good quality stuff all in one place and the volume of people start not needing that accommodation, what's going to happen? People start dropping their rooms to...
Well, that becomes the new norm, right? That's then the standard, and it's not amazing anymore.
Well, exactly that. So it's more than location within the location.
Yeah.
And also only a certain amount of people need HMOs in any said given area. So if vacancies start to occur, those HMO landlords will start dropping their room rents by 50 quid here, 50 quid there. Then that has a knock-on effect, because then the people go to that one, then they have to drop and it goes to that one. So that's the other reason why suddenly you might get a certain location where a yield is, I don't know, 11%, 10%, and the room rents are £950 a room. But then 6 months later, someone else that's trying to get that kind of same quality of value is suddenly shocked because their room rents are only 800, because saturation's occurred over that 6 to 9 month period, and room rents have actually started to taper off.
Which we're seeing and hearing that people's occupancy in certain areas have dropped off for that exact reason.
Yeah.
So you're saying quality is one thing, but train station, super important, hospital, super important.
This is
Conservation areas, nice
location,
nice architecture.
Definitely for the yields.
Makes a big difference to the yields.
Yeah, definitely for the yields, because the valuer is going to look beyond the HMO side of things and look at the next investor or family that's going to buy this. What is the house actually going to be valued at? And that's going to be normal things.
Yeah.
Location, quality, size.
What would be the 3 things that you would say for someone coming into a new area, maybe a patch within Essex? What would be the 3 things that you would do to prepare to start looking for your first HMO?
Well, I mean, the first thing is to go on spareroom.com, something like that, just to see what the occupancy levels are in the area. I know you said 3, but I'm probably going to go beyond 3. That's what I do. So I'd definitely go on spareroom.com and speak to a couple of local agents to see what the current supply and demand is, because obviously you want to go to an area where, there's a queue of people waiting for good quality HMOs. The next thing I'll do is start, sizing up the type of properties in that area and trying to get an idea of the right type of property that I would be able to convert to a 6-bed HMO in terms of the sizing.
Yeah.
To make sure that the size obviously qualifies within the HMO parameters, minimum sizing, but also is big enough to command the bigger room rents. Obviously the location within the location, like, is it near hospitals, train stations, businesses, bits and pieces like that. Once I've kind of done that due diligence and understood whether it is actually a good area for HMOs, it will then trying to find out if any valuations have been done in that area. So again, speaking to local agents, it might be speaking to people like ourselves, where we can then speak to valuers to see if they've had any HMOs in that area where they've done valuations on. We can also speak to lenders to find out the information. Once we've got that and we've got a good idea of, room rents and yields, we've got a rough idea, the client can then go that one step further and start getting an idea of what rough build costs are going to be for said property to turn into a 6-bed HMO. And then if the numbers all stack from that point, then happy days. But I definitely think those are the initial steps that you've got to take to make sure it's actually going to be a good area in terms of actually getting you the tenants in, and actually the yield and the room rents quantify for a good enough commercial valuation, so that you don't find yourself in negative because of the build cost element being quite a big element of a conversion.
Which again happens, doesn't it? We speak a lot about people going into a HMO conversion and their margin of the equity they're creating is sometimes loss-making.
It is loss-making, but I think some of the people that are very new into HMOs do need to probably understand that if you're doing HMOs, unless you can go into the 7, 8, 9 bed HMOs, which I wouldn't advise you do as a brand new first-time property investor. I'd always stick to 6 below and do it under PD. Unless you can get into the 7, 8, 9, then you ain't going to be able to pull much money back out. You're not going to make much of a profit. A lot of the HMOs now are just breaking even, like you say, but the whole point people do them is the cash flow, long-term cash flow. Making like 4 or 5 grand a month, and then netting down after costs. It's still a very, very good income. People were talking. I had a conversation earlier today about, a client that was just saying that buy-to-let's dead from an income-producing perspective. Yeah, you're probably right. Unless you can get really decent below-market value deals through auction or through sources or whatever, probate, then yeah, HMOs probably still is the way forward. But yeah, just got to make sure that your area is not saturated. There's a decent demand for HMO in terms of tenants, and the numbers stack. And like I said before, I have great pride in helping support people work out the financials to make sure it's going to work.
Good advice. One strategy I've heard of recently, it's not really a strategy. Everyone wants to get rich quick in property in a lot of circles and in life. We're all in a rush. But one interesting strategy, I spoke to a HMO developer. They've done a lot over the years, and they've owned a couple of HMOs for 5 or 6 years, and they converted 3 to 6 beds, and they're just going back 5 years later to do the loft and create into one a 7 bed and one an 8 bed.
Oh, after getting planning.
After getting planning. So you buy it, do your build, refinance it, get out of the short-term position, get some cash flow in, you built up some experience, not in a huge rush at that point, go for planning, you got planning, you can sit on it for a year or two and then implement it. Obviously you got an issue with existing tenants, but they've had some tenants in there for a while and they needed to give it a refresh. So they're literally giving it all a refresh and converting the loft and then reletting the whole block or the whole house. And that kind of gets around the experience, not that that's what they was doing, but the experience issue and the planning issue. Sometimes if sui generis is delayed or you have them issues, you've still got the asset. You can still go back and revisit.
Or build the 7th room in the first instance and put it as a games room.
Or that.
And then get planning.
But one of the issues with that is obviously adding your cost to do the conversion. You know what I mean? So if you can get in and out, I mean, all of them work for sure, but yeah, everyone's in a rush, and I thought that was quite an interesting, quite a safe way. Get in, get out. Your cost is solely on conversion, moving walls around, ensuite, kitchen and stuff, and you haven't got this big cost of a loft conversion.
No, I make you right. I guess as long as the supply and demand statistics haven't changed up until that point, at that point, that's where you then need to relook at your house, as in, I don't mean the house, I mean get your house in order, and make sure that doing the 7th bedroom is actually going to be worthwhile.
Yeah.
It'll be worthwhile from a refi perspective, but actually a valuer coming back out to do the refi might actually then down value.
Yeah. Good point.
Not just going to affect the original mortgage, but if you're doing a further advance to get that extra money out for that 7th bedroom, it might not be worthwhile.
Yeah.
But I hear your point, and I think it's a good idea, especially for the inexperienced people that want to take their get the valuation higher and put more money out.
Because everyone's got a different worry, concern. Everyone's got a different risk profile, different profile in general. So I think it's just good to not follow someone on Instagram and just say, I want to be like them, because their journey, their path, their everything, their pot of cash, their experiences could be very different to yours. So loads of different ways to skin it. Yeah.
And do you think HMO is going to be the flavour of the year going into 2026?
It's interesting. It's a topic for another day, but
another day, another episode.
Yeah, but I don't think buy-to-let's dead. I think that buy-to-let's dead if you want to get rich quick. But everyone wants to make money really quickly. I know why people do HMOs. We're talking about HMOs in this podcast, but buy-to-let, there's so many factors with buy-to-let that isn't dead. And that's why some HMO guys are getting a little bit bored with doing HMOs, because it's becoming more saturated. Voids are becoming a bit more of a thing. So I think there's different strategies like portfolio buying, build to rent, all them different things that are happening. But there are some people that are still doing HMOs, but then topping up their portfolio to diversify and buy to let, but knowing that that buy to let's probably not going to materialize into anything meaningful for 5-10 years.
Yeah.
So I think the smart move, which some people are doing, is to diversify in both camps instead of going all HMO. But that's a personal preference. Fair. But what do you think?
Yeah, look, I think as long as nothing major changes with how lenders view the current setup and structures and the way values, and the way valuers currently look at things, then I think, going 2026, HMOs can still be a thing. I think people do have to watch out for saturation and need to understand how values can start to turn because of saturation, and be mindful of it and aware for it going into the situation. So it's hard because you've got to find that you've got it's all about timing. So in order to get into the right area, for me, it can't be too I'm trying to think of the word I'm looking for, too immature. You need to go into a market where it has a tiny bit of maturity. Yeah. Because going into a too immature market, you get valuers that are not going to value it correctly because they don't have the comparables in terms of rents and sale prices. Yeah. So then you find them playing on the side of caution.
Being too clever, too quick.
Exactly. Like everyone's trying to find the next area. But it's tough. It's tough to do that without the proof for the valuers. So then we're going finger in the air. But yeah, look, I think there's still a lot of areas where HMOs can thrive and investors can benefit from that. So yeah, I know we've had a couple of areas this year. Last year it was some different areas. So I just think that's going to keep happening for the next couple of years, in my opinion.
There's always buzzwords in the industry, isn't there? It goes from deal sourcing to serviced accommodation to HMOs, social housing to resi to commercial, commercial to resi, sorry. All them different things. But HMOs still are popping because of the cash flow. You could do one HMO in Essex and it could cash flow you £2,000 a month. Yeah. But that's some people's jobs. And that's what a lot of people are looking to do, replace their income.
Yeah.
So I guess that's the
nice.
HMOs for now.
HMOs for now. Thank you very much for joining us again for another episode of Finance and Foundations, and I appreciate you listening to us waffle on. Until next time.
Thank you.